Pinduoduo reported their quarterly figures before the market opens, and now the market is open. The stock is down close to 30%. Yes, that's a 30% haircut, just like that. Stock is now back under $100, has a market cap of $137 billion, has a forward PE of 7.9 times. Year to date, the stock is now down over 30%. Year over year, stock is still up around 23% or so. Now, this company, it did miss revenue, beat on EPS, and look at the analyst estimates right now. Of course, in the coming days, more analysts will come out with new price targets, etc., etc. But right now, this is a company that is expected to grow quite fast in fiscal year 2024. Still, then around 30% growth fiscal year 25 and around 20% growth fiscal year 2026. Has a forward PE of 7.9 times, EV to sales 1.6 times, EV to EBITDA 5.3 times. So definitely not the expensive company out there. Now, of course, yes, it is a Chinese company, so you get that discount, let's say the risk added to it, which is why it's not trading at a higher multiple. Then if we compare it to Alibaba, compare it also to its 5-year mean, Pinduoduo is cheaper than Alibaba on a forward PE, on an EV to EBITDA. Price to sales, it's a little bit more expensive. Price to free cash flow, it's less expensive, it's at 8.6 times. Alibaba is at 10.8 times. Price earnings to growth, that's quite crazy. Both of them under 1. But Pinduoduo currently at 0.22 and Alibaba 0.87. Again, both companies very cheap, but both companies do not get the premium multiple because, well, these are Chinese companies. Now, I know some people say, oh, Chinese companies, I'm not investing in that because it's controlled by the CCP, etc., etc. Fine, I can understand that. If you don't like it, just don't buy it. But there are some people that are like, look, at these prices, risk reward, it might make sense, right? I don't think it will get delisted. I don't think these companies are going to zero. And I firmly believe that these companies are worth more than the price you're paying for today. So, okay, I can understand both sides. Now, let's have a look at what they reported. Let's also compare to what Alibaba reported a couple of weeks ago. Now, let's conclude this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if not. Would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to food.com/couchinvestor. Thank you very much. So for the quarter, they missed revenue by around $610 million, but beat adjusted EPADS by 41 cents. Now, you might say, oh, that's quite a big miss, right? $610 million. Well, is it? Because total revenue came in at $13.35 billion, up 86% year over year. So despite the miss, it's still growing 86% year over year. Operating profit increased 156% year over year to $4.48 billion. Non-GAAP operating profit also increased 139% year over year. If you look at net income attributed to ordinary shareholders, that came in at $4.4 billion, also an increase of 144%. So yes, okay, fine. It did miss revenue, but revenue still increased 86% year over year. That's quite tremendous. Now, the main issue is, as always, as we've seen in past reports, is guidance. What does management tell us? What do they see? And here is basically what they told us. While encouraged by the solid progress we made in the past few quarters, we see many challenges ahead. We are committed to transitioning towards high-quality development and fostering sustainable ecosystem. We will invest heavily in the platform's trust and safety, support high-quality merchants, and relentlessly improve the merchant ecosystem. We are prepared to accept short-term sacrifices and potential decline in profitability. Of course, you know, if you read this, if the market reads this, well, it's direct pressure on the stock. We are committed to nurturing a healthy and sustainable ecosystem where high-quality merchants thrive. If you've used Temu, if you've gone on Temu, you know it's absolute garbage that you find there. It's very cheap, but it's garbage. We will vigorously support high-quality merchants while firmly tackling low-quality ones, continuously building a healthy and sustainable ecosystem. In the past quarter, our revenue growth rate slowed quarter on quarter. Looking ahead, revenue growth will inevitably face pressure due to intensified competition and external challenges. Profitability will also likely be impacted as we continue to invest resolutely. So here they basically admit competition is heating up. We are making changes to our business as well. So expect revenue and profitability, so margins, to be impacted in the coming quarters. How long will this last? We don't know. But of course, as this company has grown year over year, 86%, 90%, 100%, you're lapping those now difficult comps. So that's probably why you see a nice haircut for this stock. Now, that said, the company is still growing quite nicely. Even if that pace is dropping, it's still expected to grow faster than the overall market by quite a lot. Now, of course, if they see increased competition, then maybe things might get worse than before. Maybe Alibaba, AliExpress, Tmall, Taobao, and all of that, Amazon, TikTok, whatever. Maybe they are taking market share. Maybe now they are feeling the pressure. Could very well be. So again, the market right now said, okay, maybe this is an overreaction, but currently we think a 30% haircut is warranted. Then let's see what happens. If we think that things are not as horrible as they seem, okay, we'll buy up the stock. And if not, then the stock will continue to slide. Now, as for Alibaba last quarter, we've seen, of course, Taobao and Tmall Group, that's their China segment, that was down 1% year over year. But Cloud Intelligence grew 6% year over year. Alibaba International grew 32%, so that keeps on growing quite fast. China Logistics up 16%, and then you've got some other stuff there as well. Overall, they increased revenue by 6%. Of course, Alibaba is not growing as fast as Pinduoduo. It is bigger revenue-wise. It also has different segments, right? I don't think Pinduoduo has a cloud segment. So that's what you will get when you're buying a company like Alibaba. It's also buying back a lot of shares. So in Alibaba, you're not only getting an e-commerce company, but you're getting basically, let's call it the equivalent of a Amazon. Now, of course, it's far from being as big as AWS, their Alibaba Cloud. As you can see right here, the worldwide market share of leading cloud infrastructure service providers in Q1 of 2024, AWS sits at 31%, Azure at 25%, Google Cloud 11%, Alibaba Cloud here at 4%. So this is what you're getting. Plus, if Pinduoduo does feel the heat from competitors, maybe finally we are going to see a reacceleration in growth for Alibaba, or more specifically here, Taobao and Tmall Group, while the other segments continue to grow as well. This is also a company that is supposed to become more and more profitable. Now, granted, the Chinese economy is not doing great, so yeah, you have to take that into consideration when you're in buying these types of companies. And so looking at the stock right now for Pinduoduo, we are now at under $99, which previously, I mean, it could look at the past here and say, oh, maybe these areas right here under $100 or so could be a support, right? We've seen this already here, September of 2023, previous resistance here back in January of 2023. So maybe that can happen again. We can see this as a support area, or of course, since we are in no man's land here, it could always go lower. RSI is low now, but far from being oversold. Quickly looking at the daily, here on the daily we are oversold, and if we actually zoom out and look at the August 2023 period here, we have a gap here that could get filled between around $80 and $90. That's a gap. Again, not all gap get filled, but most of them do. That's still a long way down, but just so you know, on the daily, we've got a gap right here. So overall, to conclude, Pinduoduo, Alibaba, I think going with Alibaba is, let's say, a safe bet right now, because you don't have that 30% haircut and the upcoming quarters that will probably be weaker than expected. But on the flip side, if you owned Pinduoduo, your position is now worth 30% less, despite revenue increasing 86% year over year. Small revenue miss of $610 million. Yes, some negative commentary from management, but is this the end of the company? No, I think not. I think this could be an opportunity if of course, you want these types of exposures. That's just my opinion. I have no positions in Alibaba or Pinduoduo at the time of making this video. Do share your thoughts down in the comment section below. Like, subscribe, do all of that, and I see you all in the next one. Bye-bye.